Welcome to Preserving Your Wealth with Mike McCormick, where we talk about smart ways to invest and preserve your money. Mike is a registered investment advisor with McCormick Financial Advisors in Bozeman, Montana. As an independent fiduciary, Mike does not receive commissions from any of the products or investments mentioned on this program. Consult a professional before making any investment decision. You can find old shows archived at McCormickFinancialadvisors.com. Learn, participate, interact.
And Mike McCormick is in the house. Thank you, Mike, for being here. We appreciate that very much. And,
thank you very much for having me. I appreciate that very much.
Happy to spend the time with you. The market's up 117 points right now. We're approaching 2,900 or 29,000 again.
Oh, boy. It's not normal.
I know.
It's not normal. This decade, well, we're in a new decade, of course, but the last decade, not normal.
Pretty scary. Yeah.
Not normal.
Yeah.
We've seen some gains in the previous decade that were over 400%. Mm-hmm. A four-bagger, if you want to use the crude term. Now, that's wonderful. This is people's hard-earned investment, savings, retirement money that they're investing and doing nothing. And it's going up. It's magic, and it seems risk-free when you talk about it in these contexts. And of course it's not. Of course it is not risk-free. Of course there is danger ahead. But it is a time when we're seeing a lot of really interesting, good reports come out about investing in the past decade. Leading up to the year end, there was a few things that came through. But right now we're seeing the ones that really wrap together the whole 10-year shebang, from recovery of the Great Recession to brand new highs to America actually being great.
Yeah.
And what a few things caught my eye about it. One is a great headline that came out and said, again, this has really been a gain for the wealthy. This has really disproportionately rewarded the people that can afford to A, invest in the stock market, B, afford to stay invested in the stock market. Now, normal people have normal lives that have normal, sometimes catastrophes, sometimes just hard times, sometimes just good concerns about what the heck is going on. And the report basically said that good headlines about slow improving things don't happen very much. They don't sell news. It's the shocking, scary headlines about one-time scary things that do sell news and that affect us most emotionally. And so that's what affects most investment behavior. There's always a reason to be frightful. I'm not discounting them. I never do. These are real things that we're dealing with. But when you step back and you say, well, the years from 2010 to 2020, gosh, you'd be silly not to have just put all your money into the technology index or whatever stock you want to pick, right? And it was, of course, harder than that.
If you bought the NASDAQ, you'd be in pretty good shape
now. Oh, my gosh. And in hindsight, of course, even at 2010, we were addicted to cell phones. We were only working using computers. The promise of telecommuting and all those things was just happening. Yeah. Shaney out there?
Yeah, I'm here, buddy.
All right.
House.
Yeah. Hey, we got some snow today.
Yeah.
You did indeed.
Big, heavy springtime snow. So I appreciate coming on an hour later. Give me a chance to clear the driveway.
There you go. Well, I would take issue with one thing that you said. About,
good. We can have controversy.
Yeah, we can have
morning.
Controversy here this morning. You were talking about the wealthy benefiting.
Yeah.
What about the 401k? What about the IRA? What about the individual investor who's invested through their work or whatever? Are they not benefiting as well as along with the rich guys?
Of course, Tom, you are correct.
Of course I am.
However, they have not benefited proportionally.
Well, they've benefited proportionally to what they have invested.
Sure. But statistics are clear. Most people don't have more than $50,000 saved for retirement. And if you had $50,000 saved for retirement and you were lucky enough to pick the NASDAQ and got the 4-time return, now you now have for 50 times 2, 50 times 2 again, 50 times, you have a good return.
Yeah.
I'm not good with simple math on the fly. I'm good with complicated relationships on the fly. Simple math, we could use a caller for this one.
Okay.
But, and I would even add to your argument that lower income people have benefited from a strong economy, from trickle down economics, from maybe a lighter tax weight than they might have otherwise had, although some people would really firmly argue against that. So yes, of course there's benefits. However, the gains that we've seen in net worth on a percentage basis have been realized by the top top 10% disproportionately. And maybe that's capitalism. Maybe that's the way it is. I'm not saying that there was anything necessarily wrong with it. There needs to be a reason to go and work and to envy the person that is making a bunch of money, because it promotes getting after it.
Yeah, it does. Well, and also, too, and in many cases, that wasn't handed to them, I mean.
I'm not saying it was.
Yeah, no, I understand that, but I mean.
In many cases, it was, however.
Well, 30% maybe. I mean,
that would be an interesting study, right? Is it?
Yeah, 30%. Well, if you look at the Forbes 500.
Old money is 30%?
30% is inherited, and 70% is pretty much you made it somehow on your own, and particularly the top 15 or 20.
I'm reading a really interesting book about preserving durable family wealth right now. That the adage of the shirt sleeves in 3 generations. It's a fascinating read, and the gist of it is that if you happen to be a family that is inheriting money and you're aware of this problem of shirt sleeves, there's some things that you should probably be looking seriously to do to not be the statistical norm, which is that after the 3rd generation, it's a negative proposition out there.
All right, we've got a text question for you, which I will answer first, and then I can have your answer. Question for Mike: why should I pay him to manage my money versus buying an index fund with an online broker? Well, if you've got the type of money that Mike manages, it's a lot more complicated than doing it with an online broker. So you can answer that question.
I must have given you a good Christmas present. This is a wonderful question, and this is really the core of the reason why I'm here on the show. This is my opportunity to help promote financial literacy to all of our listeners, to share what higher net worth people are doing. I don't have all the answers. There's a lot of great advisors in town, and so I do encourage anybody that is interested to learn and to potentially invest on their own. And a lot of people that I get phone calls from the show, I urge them to do just that. Now, investing on your own is lower cost, and it's one of those things, if you have the right behavior, you can be very successful. And over time, the numbers are clear. You're going to make more money if you don't pay somebody else to do it. I don't have special sauce. I don't have hot tips. I'm not subscribing to this newsletter of insiders that is.
You don't have the stock of the week, do you?
Everybody has the same information available to them as me. It's simply that I have dedicated, like all the other financial advisors in town, my life to the study of trying to help people manage their emotions and cater to their particular needs. And so to Tom's point, the people that benefit most from what I do have businesses, have busy lives, may have situations where they're not interested in learning about these things and managing their own money, a variety of things. So yes, there is a great opportunity for people out there to make more money by not passing it to a financial advisor or other sales type of person.
Yeah. Well, we pointed out many times on the show that every year there's the top 10 investors, and the next year those guys are gone, and there's another top 10 up there because nobody's consistent in being able to predict the market.
Nobody is consistent in predicting the market, which is why I promote passive Vanguard style of do-it-yourself investing.
Be safe,
Well, right.
Yeah.
And take risk, because if you wouldn't have taken risk this last decade, being too safe means you miss out on a great opportunity. But when we're talking about how advisors do help people, statistics show that most investors get about half of the return of the market because of their behavior. And so if your advisor is saying, no, we're not selling right now because Iraq might attack us, they are earning their money because they're keeping you from making a bad decision. If they're saying, and this is a conversation I'm having a lot with my clients right now, is we'll come in and we'll talk about retirement plan contributions, and I'll look at their account and give them their returns, and I'll say, it was a pretty good year for you last year. And they'll say, oh, yeah, it was great. And I'll say, it doesn't seem like you're saving that much. And they'll sort of get, uncomfortable, right?
Right, yeah.
And I say, these are the salad days right now. For you should be saving more. And I'm not saying it should be invested in the stock market. It's a big decision when you go from a retirement account.
Reduce debt.
Of course, they're all maxing
things.
out their retirement accounts. They may have a trust or something in addition to that, but it might be paying down. I had a conversation with a realtor yesterday that's one of the top realtors in town, and I said, I want you to, you haven't invested in money in real estate because you're concerned that's expensive. I'm not going to take the dollars and put it in the stock market. How about paying off your house? 4% guaranteed after-tax return. I don't have a 4% guaranteed return vehicle right now.
Yeah.
Tax benefits of mortgage interest have gone down. So in terms of what advisors can do for people, it's as much a behavior thing, but there's other things outside, if insurance, legal aspects to estate planning, helping shop for daily consumer items, cars, RVs, second homes, all those sorts of things. So
well, and you've also got the SALT rejection. No more state and local income tax taken off your taxes. So
you got it.
If you got a substantial income, that's something to think about.
For sure. Tax, good CPA frequently is the best spot to go, especially for people that aren't. If you think you can do the Vanguard thing, still get a CPA. That doesn't go away if you ask me.
Okay. We got another text question. We got to take a break, though. I want you to think about this as we come back. What is my tax liability on inheritance from a parent's estate? So that's from Dave, and we'll talk about that when we return.
All right.
So stay tuned. Jamin Taubman, half man, half amazing in Vancouver. Tom Eagleoff, your morning mayor. And we've got money guru Mike McCormick, McCormick Financial Advisors in the house. We'll be back with more with Mike right after these important words. Stay tuned. 20 minutes after the hour of 8 o'clock, we've got a caller waiting on the line. We got some text questions for Mike, so let's go to the phones. Caller, you are on the Morning Soapbox with Tom and Shane and Mike McCormick. What's up?
Hi, my name is Chris. I'm actually not calling about finance. I'm just calling to let everybody know that the I-90 interstate is a parking lot from 19th Street to, Belgrade, going east.
Wow. Okay.
Yep. So I don't want anybody else to fall into the same trap I did. I was getting ready to go to work, and I jumped on the interstate, and that was a mistake. So if you're headed going east, you might want to take the frontage road because it is literally, first day of snow in Bozeman, and I don't know what happened here.
Yeah, it must be some kind of an accident up there somewhere, so... All right.
Oh, I'm sure.
Yeah.
Okay, just letting you know. Thank
All right.
you.
Hey, thanks so much. Yeah, we appreciate it.
Appreciate the update.
Yeah, we appreciate that very much. Yeah, thank you very much. All right. Yeah, watch out if you're heading out on I-90. You may want to detour through Belgrade and take Huffine or the frontage road or one of those two to get to Bozeman if you're going that direction. So let's see. Mike, we had the question, why should I pay you to manage my money? We did that one. Why not buy an index fund and forget about it? Managed funds perform the same as index funds, and management fees are taking a big bite of my portfolio. What is that getting me versus index funds?
Also a great question. Index funds are relatively new in the landscape. They did start by Jack Bogle back in the 80s, but got significant traction in the dot-com boom. And then beyond that, lately in the past 10 years, they've absolutely been taking the actively managed mutual fund to the woodshed. Now, just when you say something absolute in this business, it goes the other way. So the idea with a mutual fund is that you've got somebody that's really clever. Think any of the Wall Street investment movies where they're picking, my favorite is Trading Places, pork bellies. Something's happened with pork bellies, right?
Right.
Now, do they add value? Can they outperform the index? The statistics say some can, but those that can, at most 20% can. So if there's a bunch of people selling investment portfolios in a mutual fund wrapper, or as a financial advisor, if I've got my own custom stock picking thing, you just look at all of us and say, well, there's a 20% chance that I put my money with you and I'm going to do better than if I picked an index fund. An index fund, just for the home gamers out there, is a objectively mathematically determined allocation of your money. The S&P 500 is an indexed fund where
it's a basket of stocks.
It's a basket of stocks.
Yeah.
And it will take the largest company, Microsoft, and it'll give it that percentage. If you give them $100, the percentage weight of Microsoft in the S&P will be that percentage in your basket all the way through the top 500 stocks. It's really been the best way to invest in the past, to tell you the truth.
Yeah. S&Ps, I don't think have lost in a 10-year period. They've always had a 12% return, I think, in any 10 or 20-year period since the beginning.
I can't speak to the return, but they have not had, well, obviously they've had
serious losses.
They have not had a loss in any 10-year period.
Right, exactly. Yeah.
Now, that's if you didn't pay any fees also. So when you hear about how the when you compare your portfolio, how you did to the market, there's always a fee, even if you're in Jack Bogle's Vanguard S&P 500 fund. Those are getting down to be minuscule. So the question is there value to somebody picking stocks for you, or should you just put it in there and let it float with the market? The answer is, in my mind, this is my answer, is if you're a beginning investor and starting with relatively small amounts of money, using an index fund that is broadly diversified beyond the S&P, you should have some bonds and some international exposure, and forgetting about it is the best way to go. And over time, if you are making regular contributions into that account, like through a 401k or other retirement account, you will outperform most investors simply because every day seems scary or not, and you're putting the same amount of money into it. So you're taking the emotion out of it. Now, should you pay an advisor to do something? In some situations, absolutely. I cite emerging markets as a great place where it might make sense to use an active manager in that scenario. Who knows what's going on in terms of the corruption that's happening in Latin American countries versus what's happening in India and China. In terms of statistics, yes, you're still in the same problem where index funds seem to be doing better than most of the active managers. But I have to say, sometimes it can make sense if you're a tax-sensitive advisor. If you're a socially responsible investor, the environmental social governance boom has really been popular. If you want to make sure that your money is being invested in things that are important to you, index funds are tough to make that work because there's such a tricky subjective thing about it. So great question. I hope I did an okay job answering.
Before the break, we had the question, what is my tax liability on inheritance from a parent's estate? That was from Dave. And so it's up to quite a bit.
It's actually up to quite a bit is the proper answer to that.
Right.
There was a tax Relief Reconciliation Act of 2001. I did have a chance to look this up. That went through in 2001. And it basically said we're going to work to really raise the exemptions for taxable estates. And so back then it was $1 million per person. Now it's up to $11.2 million per person that you can die with and not have it taxed. So if you're a married couple, double that. So that's 22.4. I can do simple math on the fly like that. And so if you have an estate that's over $22.4 million and you're feeling sick and you might die, then you better go see an estate attorney. So this is a very, very small percentage, even in today, of people. So typically, no, any money that you inherit, whether it's land, whether it's property, collectibles, cash, from your parents, is not going to be taxable. What's interesting and nice about this, in my mind, is that they might hold things that have a taxable gain in them. Say that their house they purchased for $50,000 and now it's worth $5 million.
Whatever.
And they pass with it. That you don't have a taxable gain on it. Your basis, the amount that the IRS considers that you paid for it, is the market value of the day that they pass, which is a great tax holiday, really. Now, it's somewhat double taxation if you would have anyway. There's arguments about how this goes.
Sure.
But the trade-off is that, yes, for the very, very, very wealthy, there is a tax. There's a whole industry of estate planners out there that are very good at avoiding that for the very, very wealthy, and that's something else.
Yeah, or you insure it or whatever,
right.
Cover the
and I'd like to say the flip side of this too, Tom, is that any creditors against the estate won't transfer to yourself either. So if it's the opposite of $11.2 million, if it's negative $11.2 million, let's say, the creditors will attach it to the estate of that individual that passed, but they will not attach it to the beneficiaries of that estate.
Yeah, it's only the estate. They can't come after you
just
because you have to be related to the to the person or a business associate,
which is
or whatever.
Fundamentally why it can take a really long time to settle mom's estate, because you have to put the notices out there and say, okay, anybody say that my mom owed him money? No? Oh, you? Okay, we'll deal with that, and that sort of stuff.
Okay. Gentlemen, could you pro and con the difference between a living revocable trust versus a conventional will? Are there other additional documents that I should also consider in conjunction with these? So, a lot of folks use the revocable trust. Some people have a conventional will. Um,
Great question. And,
yeah.
Justin Bryan Law Firm, who I've heard some great ads on this show for, local state attorney, is the expert on this. There's other experts that do great work, but he has little snippets in there that maybe prompted this question. Both can be very effective. The living will frequently create a trust upon death that can have some of the same features. The revocable trust is really good for people that have modern families, might be the way to say it. If you have complicated assets, split families, I don't want it all to go to your kids, but this is mine and that's yours.
Yeah.
Then we'll probably go to a revocable trust. Neither one evades estate taxes. That's another level.
Yeah, a lot of people put their real estate in a revocable trust to share it with the kids. And
consult an expert.
Yep, absolutely. All right, we got to pay a couple of bills here, or get a couple of bills paid, I guess. And Shane and Tom, half man, half amazing, on the line. And Tommy Golf, your morning mayor, in the house. Mike McCormick, Investment Advisors. And this is the KMMS Morning Soapbox with Tom and Shane, brought to you by the Club Tavern and Grill. And we'll be back with more with Mike McCormick and your questions right after this. All right, welcome back. 23 minutes before the top of the hour. Shane and Tom, half man, half amazing, in Vancouver, British Columbia, the best co-host in radio history. And Mike McCormick on the line, or not on the line, in studio actually. we got him sort of on the line, but anyway,
live.
Yeah,
live and local.
That would be it for sure. Is Shane still there? He has excellent input, but he's been noticeably quiet.
That is true.
What's up, Shane?
Well, I just think in the 21st century, with now online opportunity to invest and the access to information and not paying any commissions online, I look at Ronald Reed, the janitor we talked about.
Yeah.
He died in his 90, worth $8 million. He invested in 95 stocks over 56 years. He would invest $300 to $550 a month, all dividend stocks, paid $250,000 a year in revenue, like monthly recurring income. Wow.
Yeah.
And he just reinvested it. So, excuse me, if you're scared of the market, pick the 5 best stocks that you walk around your house. If you can find 5 things you buy all the time, find out what company produces it. They pay a dividend. Open up a simple account. No fees now. No cost in buying the stock, and you can just keep watching it yourself. And the dividends flow into that account, and you reinvest it. And next thing you know, you're building up a pretty fair amount of equity. And if you're in your 30s, 40, 45 years from now, you'll find a better return. I personally think, I'm looking at the market today, and I'd like to get Mike's opinion on this. We thought the Dow would get to 30,000 because we thought that Trump would settle this issue with China. He will. They're going to sign on the 15th. I think if Donald Trump is reelected, you'll see the Dow at 35,000 before he leaves office. And the reason for that is it's a new type of growth. It's a new type of effort that he's created, and one that no one expected, no one anticipated. Everyone denied was possible. So he's creating new jobs, bringing jobs back, industries. I mean, when you see him get Apple to open up a plant in Texas to produce and produce product, knowing the added labor costs and operating costs they have, that's a pretty significant reality that the world has to face up to, that could happen in the next seven years. So why not?
Okay. There
Excellent.
you are.
I don't disagree.
Yeah. All right. Let's see. We had a question.
Hey, can I add something to Shane's little point?
Right ahead. Yeah,
if you don't feel like you want to choose individual stocks, because you do read the internet and you do favor more my camp, that individual stocks can be problematic, you can invest in an index fund that focuses on dividends. One that I use sometimes is the SDY. This is S dividend Y as opposed to the SPY, which would be the S&P 500. So it's the S&P 500's top dividend payers. And the top 10 holdings include companies like AbbVie, AT&T, Amcor, ExxonMobil, Realty Income Group, People's United Financial, National Retail Properties, that's another REIT, Leggett and Platt. International Business Machines Corp., otherwise known as IBM. Old Republic, Kimberly-Clark, Consumer Staples, Tanger Factory Outlet Centers, and other real estate investment trusts. Cardinal Health, Meredith Corp., Chevron, Black Hill, Federal Realty Investment Trust, Consolidated Edison, Target Corp., and Coca-Cola. So that is where a lot of money is going, and you don't need to be as hard. You don't even work as hard as the janitor.
Yeah.
And pick the stocks. You don't need to be a Jim Cramer homework guy. What's nice about one of these index funds is that if one of these companies starts doing poorly, someone else is going to take its place, and you don't need to swap it in.
Yep.
If all of a sudden Microsoft starts paying a 4% dividend, it's going to boost right up in there, and it'll be in your portfolio.
There you go. And if you didn't have time to write all those stocks down, they'll be in our recording, our rebroadcast.
So the ticker, and again, listen to my disclaimer. You can't do anything and say it's my fault.
That's true.
S is in Sam, D is in dog, Y is in a Yahoo.
Mike, you should open your heart to sharing your mind once a quarter with the little guys. You could end up with more big business.
Well, I the first part is true. I would love to be able to have a greater impact for the people that really need financial advice. And I was reading that there's a service at our local library where they're doing an open house. And so I used to be on their board, and I was thinking might be a nice way to go over there and have an open house that we could just have people come in, and for no fee, they could have advice. I'd invite the other advisors in town that want to participate. But
yeah, sure.
Seems like that could be good. Right.
How do you start is probably the biggest question everybody has that we ought to cover sometime on the show. We don't have enough time to do it now, but maybe, okay, I've got $25, I got $50, I got $100. What do I do with that? What do I do with that? And then if 50 becomes 100, what do I do with that?
Yep.
Then if 100 becomes 200, what do I do with that? And so on.
And what's so wonderful about where this is the theme of the show is a Vanguard or an E-Trade, or you can go direct through Schwab. There's a lot of different places. I would always use a big brand name that you Fidelity. You can invest $5 into one of these things that I talk about.
Oh, sure, yeah.
And I don't want people taking, their whole Christmas bonus and putting it in there when they haven't had a history of an experience of investing. That's why this janitor works so well, is that he was doing small dollar regular stuff that didn't impact his daily ability to live his life. Because, here's the sad news. As much as we want to change some of the behaviors that we're doing, it's really hard.
It is. Before we let you go, front-loaded investing versus recurring fees.
Right. Big question. Okay, so to the person that's asking the question has some knowledge. Maybe they're faced with this. Typically, it's a 5-year trade-off is the gist on it. So if you think you're going to be with that particular investment style or strategy for more than 5 years or investment, it might make sense to go with a front-loaded fee without getting too deep in the woods.
Right.
Frequently, things change. That's where the annual fee happens. And to the theme of the show, again, a financial advisor can be very valuable to you if you're somebody that uses advice. If you're a business owner, if you have a changing life, if you're dealing with a lot of complicated things, or you feel like this stuff is duck soup. There's a lot of things in life that make a lot of sense when you hear them, and then you walk out the door and, what was that? Taxes for me are like that. And just because I can change my own oil, it's really worth it for me to have somebody else change my oil.
That's true. Yeah. Any recommendations for an estate attorney for those on fixed incomes? Well, I would start with the Bryan Law Firm that advertises here on KMMS, gives you tips every now and then. And if they aren't able to help you on a fixed income, perhaps they can refer you to someone that can't. So.
It's the big problem out there where if you don't have a lot of money and you need help, it's tough.
It's tough, yeah. It is, yeah. All right. Thanks, Mike. We've got to pay a couple bills here, or get a couple bills paid to us, or something. I don't know. Whatever we do here, I forget what it is exactly.
We got to feed the monkey, don't we?
Yeah. We got to feed the pig. Whatever. So, all right. Thanks, Mike. Mike McCormick, McCormick Investment Advisors.
You can text Tom if you want to get a hold of me. It doesn't really matter.
How do they get a hold of you?
You can see if Google can find me after that alphabet soup. Otherwise, 522-3201. Thank you so much for all the great listener questions. Thanks to the gentleman that pointed out the traffic problems on the interstate. That is community radio at its best.
All right.